Imagine you're running a business that takes scrap metal, car doors, old I-beams, appliance parts, throws it in a giant electric furnace, melts it down, and sells it as brand new steel. That's essentially steel dynamics. And this week, they just reported a quarter where revenue grew 19% year over year, the stock jumped 5%, and yet they missed earnings estimates by nearly 14%. How does that happen? That's what we're here to figure out today.
It's one of those quarters where the headline numbers tell two completely different stories. Revenue blowout on one side, earnings miss on the other. Steel is a commodity business, Hudson. The spread between what you charge and what your inputs cost is everything. And that spread got squeezed in Q1.
Welcome to Charged Alpha. I'm Hudson Thomas here with Lana Chen. Today we're breaking down Steel Dynamics, ticker STLD, a company that's been one of the best-run steel producers in America for over 30 years. Let's get into it. Steel Dynamics was founded in 1993 in Butler, Indiana, by Mark Millett and a small group of steel veterans who had spent their careers at Nucor. They had a vision: build a leaner, faster, more efficient steel company using electric arc furnace technology instead of the old blast furnace model that dominated the industry for a century. Today, STLD is headquartered in Fort Wayne, Indiana, and has grown into one of the largest domestic steel producers in the U.S., with annual revenues approaching $20 billion and about 13,000 employees.
The company operates through three segments, and understanding all three is key to understanding the business model. Steel operations is the engine, producing hot-rolled, cold-rolled, and coated flat-rolled steel, plus structural beams, bar products, and specialty grades that go into construction, automotive, and manufacturing. Metals recycling operations is the feedstock advantage. STLD owns OmniSource, one of the country's largest scrap metal recyclers, which supplies raw material to the mills at competitive cost. And steel fabrication operations is the downstream play, turning steel into finished building components like joists, girders, and steel deck for non-residential construction.
That vertically integrated model is really the secret sauce here. Most steel mills have to buy scrap on the open market at whatever price the market demands. Steel Dynamics has its own supply, which gives it a structural cost advantage, especially when scrap prices spike.
And the end markets matter too. STLD sells to construction, automotive, manufacturing, transportation, heavy equipment, and pipe and tube, a diversification that provides some cushion when any single sector softens. Right now, the why now story for STLD is a complex mix. Tariffs are driving domestic steel prices higher, which is good for revenue. But those same tariffs are also inflating scrap and input costs, which is bad for margins. Q1 2026 showed exactly what happens when those two forces collide.
Mark Millett isn't just the CEO of Steel Dynamics. He's a co-founder who has been running the company for 31 years. That kind of tenure is extraordinary in corporate America. He grew up in England, studied metallurgy at Brunel University, and then came to the U.S. to join Nucor in the 1980s, where he learned the electric arc furnace playbook under the legendary Ken Iverson. Then in 1993, he helped start STLD from scratch.
What's interesting about Millett's leadership style is the decentralization. He runs a relatively lean corporate overhead structure and pushes authority down to plant-level operators. The thinking is that the people closest to the furnace know better than headquarters how to run it efficiently. That culture has delivered consistently strong returns on equity over decades, which in a cyclical commodity industry is genuinely hard to do.
He's also been aggressive on capital allocation, buybacks, dividends, and a series of smart acquisitions to expand the recycling and fabrication segments. The market generally respects him. The question heading into Q2 2026 is whether the Q1 earnings miss is a one-quarter anomaly or the start of something more persistent.
Let me take you through the Q1 2026 financial picture. Starting with valuation, Steel Dynamics trades at $220 per share, with a market cap of about $31.9 billion. On a trailing 12-month basis, the PE ratio is 23.2 times earnings. That's elevated for a steel company, but the forward PE on 2026 consensus estimates drops to 15.5 times, reflecting a market that believes margins will recover from this quarter's miss. The price-to-sales ratio is 1.68 times TTM revenue and price to book is 3.5 times. EV to EBITDA comes in at 16 times trailing.
So the market is pricing in recovery.
It is. Now the income statement. Q1 to 2026 revenue was $5.2 billion, which is a 19.1% jump versus Q1 2022 $5.37 billion. Genuinely impressive top-line growth. Gross profit was $763 million for a gross margin of 14.7%. Operating income came in at $538 million. But here's where it gets interesting. After interest expense of $33 million and a small other income drag, pre-tax income was $513 million, tax expense was $113 million, and net income landed at $403 million, or $2.79 per diluted share. The street was looking for $3.24. That's a miss of nearly 14%.
A 19% revenue beat, but a 14% EPS miss. How does that happen?
It comes down to input costs. STLD uses scrap metal as its primary raw material. When scrap prices rise faster than steel selling prices, margins compress. In Q1 2026, scrap inflation was meaningful, and you can see it in the cost of revenue line, which hit $4.44 billion, or about 85 cents of every dollar of revenue. Compare that to the prior quarter, where cost of revenue was running closer to 88 cents, so Q1 gross margin actually improved, but not enough to meet the elevated EPS bar the street had set.
What about cash flow?
Cash flow is the other part of the story. Trailing 12-month operating cash flow is $1.45 billion, and free cash flow over the same period is $665 million, which sounds solid until you stack it against $780 million in capital expenditures. STLD is in an investment mode right now, building out capacity in Sinton, Texas, and expanding aluminum operations. But in Q1 2026 alone, operating cash flow was just $148 million, a fraction of the quarterly norm because working capital consumed a massive amount of cash. Accounts receivable and inventory built by more than $500 million in the quarter as revenue surged. That's normal when a business is growing fast, but it's a real cash flow drag in the near term.
And the balance sheet.
Cash on hand is $557 million. Total debt is $4.2 billion. Net debt is $3.6 billion. And shareholders' equity is $9.1 billion. Debt to equity is 0.46 times, manageable for an industrial of this size. Current ratio is a healthy 3.1 times. Quick ratio is 1.3 times. Return on equity trailing 12 months is about 15%. Overall, Steel Dynamics' financial health is watchful, the balance sheet is sound, and leverage is under control. But free cash flow is constrained by heavy capex, and the Q1 margin miss raises questions about how quickly earnings can recover if input cost pressure persists.
Let's talk about what analysts are saying. 11 analysts cover STLD currently, and the consensus view is hold. 5 buys, 5 holds, 1 sell. The average price target is around $241, which implies about 9% upside from current levels. The range runs from $200 on the bear end to $280 for the most optimistic bulls.
The notable calls heading into this earnings report: Wells Fargo reiterated their overweight rating on April 16th, just days before the print, citing domestic steel demand resilience as a reason to stay positive. JP Morgan maintained their neutral just 2 days earlier, noting that valuation fairly reflects the mixed cycle outlook, and Morgan Stanley made the most notable call in January, downgrading STLD from overweight to equal weight, and flagging margin pressure concerns from tariff cost pass-through uncertainty, a call that looks pretty well timed given the Q1 miss.
What about last earnings? Any pattern here?
Q4 2025, reported in January, was a different story. Revenue of $4.4 billion, EPS of $1.82 against an estimate of $1.70, so a slight beat on EPS, but a revenue miss versus the $4.55 billion consensus. The pattern is worth noting. STLD has been swinging with beats and misses as the tariff environment creates earnings volatility that's genuinely hard to model quarter to quarter.
Okay, let me make the bull case for STLD. First, domestic steel demand is strong and getting stronger. Infrastructure spending, the reshoring of manufacturing, the electric vehicle transition, all of these are structural tailwinds that require enormous amounts of steel, and STLD's diversified end-market exposure puts it right in the path of all three. Second, tariffs on imported steel are essentially a gift to domestic producers. STLD has zero foreign revenue exposure. It only makes money in the US, so every dollar of tariff-supported pricing premium flows directly to the top line. Third, at 15.5 times forward earnings, the stock isn't expensive if you believe margins normalize. And fourth, STLD has been one of the most aggressive capital returners in the industry, buybacks and dividends totaling well over $1 billion a year, funded by an EAF model that has structurally lower costs than blast furnace competitors.
Now for the bear case, and I think it's pretty clear after Q1. The core concern is margin compression. Steel is a commodity, and STLD's EAF model means scrap metal is its largest input cost. When scrap prices rise, which they have partly because scrap is itself affected by tariff dynamics, and steel selling prices don't rise proportionally, margins get crushed. Q1 showed that play out in real time. The second concern is working capital. That $500 million plus cash drag from accounts receivable and inventory building is manageable if demand holds, but if the economy softens or orders slow, that inventory becomes a liability. Third, the heavy CapEx program, somewhere between $1 and $2 billion over the next 2 years, is going to keep free cash flow constrained even as earnings normalize, which limits the buyback firepower that bulls love to cite. And finally, at 23 times trailing earnings, STLD is priced for perfection in a historically imperfect industry. Any further earnings disappointments could compress that multiple quickly.
How does STLD stack up against its peers? The most direct comparison is Nucor, ticker NUE, same EAF model, similar scale, and literally the company where Mark Millett spent his formative career. Nucor trades at about 1.35 times sales, slightly below STLD's 1.68 times. Nucor's trailing PE is around 20 times compared to STLD's 23.
On revenue growth, STLD's 19% year-over-year jump in Q1 is exceptional. Nucor's recent growth has been more modest. Both companies have gross margins in the mid-teens, which reflects the commodity nature of the business. Then you have ArcelorMittal, ticker MT, a global steel giant trading at just 0.54 times sales. That massive discount reflects blast furnace operations, higher fixed costs, and international exposure that creates more earnings volatility. And Reliance Steel, ticker RS, is a different animal altogether. They're a distributor, not a producer, with gross margins closer to 20% and a price to sales in the 1.3 times range. Within the producer universe, STLD has earned its premium valuation through execution.
On the options side, we don't have specific put-call ratio or implied volatility data available for this episode. What we can tell you is that STLD carries a beta of 1.4. The market treats it as a high-volatility industrial, and that's reflected in how options are typically priced for this stock. Earnings weeks historically see elevated implied volatility, with the market pricing in a meaningful move in either direction.
And the fact that the stock actually rallied 5% on the earnings day, despite the EPS miss, is informative in itself. It suggests the options market and the overall market had already priced in a worse outcome heading into the print. When a bad number produces a positive stock reaction, it tells you the fear was even greater than the reality. That's a useful signal for thinking about near-term sentiment. Bears may have already been running for cover.
On insider activity, detailed transaction data wasn't available from our source this episode. What we can offer is historical context. STLD insiders, including Mark Millett, have historically sold shares through pre-scheduled 10b5-1 plans rather than making open market purchases, which is typical for executives at a mature industrial company with concentrated stock ownership. We didn't see reports of unusual insider buying or selling around this earnings print.
The absence of insider buying ahead of a known earnings miss isn't surprising. These trading plans are set months in advance, and executives can't easily adjust them around material, non-public information. The more meaningful signal is longer term. How much stock does leadership actually own? Millett, as a co-founder who built this company from zero, has maintained substantial ownership stakes. And that kind of founder alignment tends to translate to shareholder-friendly capital allocation over time.
The key risks to watch for STLD going forward. Number 1 is steel price volatility. Hot-rolled coil prices are the single biggest driver of STLD's revenue and margin. Any reversal in the tariff-supported domestic pricing environment could compress earnings sharply and quickly. Number 2 is scrap cost inflation. The same tariff environment that lifts steel prices can also push scrap costs higher, since scrap is partly imported and partly competed for domestically by multiple mills simultaneously.
Number 3 is tariff policy uncertainty itself. STLD benefits from steel import tariffs, but those policies can change. Any exemptions for key trading partners or a broader trade negotiation could deflate the domestic price premium overnight. Number 4 is execution on the Mexico and Sinton capacity expansions. Heavy capital expenditure projects must come in on time and on budget, or you get the worst of both worlds: cash out, revenue not yet in. And 5th, watch the working capital cycle. The Q1 build of over $500 million in accounts receivable and inventory will either resolve cleanly in Q2 or signal the beginning of a demand slowdown. That data point will be very telling.
So what's the bottom line on Steel Dynamics? This is a best-in-class operator in a notoriously cyclical industry, and Q1 2026 showed both the strength and the vulnerability of that position. Revenue grew 19% year over year to $5.2 billion, a number that reflects real demand and real pricing power, but EPS of 2.79 cents missed the 3.24 estimate by nearly 14% because the spread between what they charge for steel and what they pay for scrap got squeezed.
The stock rallied 5% on the day, which tells you the market expected worse. At 15.5 times forward earnings, STLD isn't expensive on a normalized basis. But the key metric to watch is the hot-rolled coil to scrap spread, the difference between steel selling prices and scrap input costs. That spread is the clearest real-time indicator of whether Q2 margins are going to recover from the Q1 miss or continue to compress. If that spread widens, STLD looks very attractive. If it narrows further, the forward earnings estimates are going to come down, and so will the stock.
We'll leave you with a line from Ken Iverson, the founder of Nucor, and the man who essentially trained the people who went on to build Steel Dynamics. He once said, "In the steel business, you either have low costs or you have problems." That's as true today as it was when he said it, and it perfectly frames the challenge and opportunity sitting in front of Steel Dynamics right now. They have among the lowest costs in the domestic industry. The question is whether costs are low enough for long enough to keep the earnings on track.
I think that captures it perfectly. Low costs are the moat, but the moat still has to be wider than the headwind.
That's going to do it for this episode of Charged Alpha, your deep dive into Steel Dynamics, ticker STLD. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.